Hello, everybody. Welcome to another edition of the 1 Million by 1 Million podcast. Today, I'm speaking with Kanwaljit Singh from Fireside Ventures. Fireside Ventures focuses on the Indian ecosystem. Welcome, Kanwaljit. It's great to have you.
Thank you, Shramana.
So let's start by introducing our audience to you as well as to your fund. Tell us about your investing focus. How big is the fund? What kind of investments do you like to make?
Sure. Thank you so much. So we are early stage fund based in India, and we are a exclusively focused fund on the consumer brand space. So what I mean by that is that we basically invest in companies in spaces like CPG, food and beverages, personal care, essentially consumer products and consumer brands which are targeting the new millennial in the Indian context. This is an early stage fund. We have raised about $50 million from mostly Indian investors with a very interesting profile of investors. We have family offices in India which are representing consumer companies that they have built. We have large consumer corporations who have invested in the fund. So it looks like this whole space of consumer brands and early stage entrepreneurship in this space has become quite exciting, and not only us but an entire ecosystem is developing to help support and understand this space a little better.
Fantastic. It's one of the great opportunities for India, I think, going forward, is to build real homegrown major consumer brands. Absolutely. So how big is your fund?
So we are a $50 million fund. So think of it as a pre-Series A to a Series A stage of investing.
Okay. And what size checks do you like to write?
Sure. So we basically, the whole thesis that we follow is that consumer brands require multi-stage funding in the beginning because they have to start from proving their basic concept, then create infrastructure for distribution and the brand building, and then of course the growth drivers. So we can go as early as $250,000 and all the way up to a couple of $1 million. So typically we would work within this range, but typically start with a smaller check and then write the next few checks to the fund so that the companies can continue to focus on building the brand.
So that's great. Now let's double click down on two issues. One is, firstly, what does a company have to have in terms of proof points for you to want to write a $250,000 check?
Sure. So the first check we write typically is backing the entrepreneur, obviously. And while, it's a cliche term that you're backing the jockey before the horse, but in our case, it becomes even more important because we are almost working with the company to establish the product market fit. So as long as they have an interesting product in a space that we believe is an emerging space and targeting the right consumers, we basically bet for the first check on the entrepreneur and then try and work with them to develop the thesis around the product market fit.
And the entire focus of the fund is on original consumer products, private label original consumer products, not e-commerce channels.
No, not at all. In fact, we are very clear that we will invest behind, as you called it, original brands. Essentially, the range of these brands is pretty wide. We already have investments across food and beverages, personal care, education, home products, so lifestyle. But yes, it has to be a brand play and not a retail or a marketplace play.
Okay, great. And the other piece of this equation is, so let's say you can go from $250,000 to $2 million per company funding. What does the rest of the ecosystem look like around you to build brand companies? And what are they looking for in terms of proof points to want to come and play with you in deals like these?
So that's a great question. Actually, that was one of the motivators for us when we started the fund, that there really does not exist a very robust ecosystem in India for supporting these kind of brand plays. So what we have been able to do in a short span of last 1 year since we started is actually start the process of building this ecosystem. Interestingly, one emerging investor group that we work very closely with is actually Indian family offices. And like I mentioned earlier, the investors in the fund itself are a lot of these large Indian family offices. So they are interested in co-investing along with us. But like you rightly assumed, they want to come in at a stage when the company has already established the proof of concept. They already have an existing business. So typically a Series A, where the company may be looking for, let's say, $3 to $5 million, where we can bring in one portion of it, and the rest of it we can source from the family offices. So our whole fund model is based on this belief that we can heavy lift the businesses from very early stage to the point where they have established at least the basic model in the market. And that's when we can partner with some of our own investors and, of course, some of the other investors out in the market to help the companies raise the growth capital. Typically, that tends to be $3 to $5 million.
And so that almost precludes the existing venture capital ecosystem in India. Is that a correct observation?
No, not precludes. I think it is also a matter of evolution of the venture system in India, because most of the venture capital funds or the more institutional players are still very much focused on tech plays. And because of that, one of the gaps we saw in the market was that since nobody was really looking at the space of consumer brands, we felt that, like you said, opportunity is very exciting. So we felt that we could fill that gap. So it doesn't preclude them. Obviously, we work with most of them. I have been in this industry for the last 20 years, so I know pretty much all the VCs very closely. But since they are not looking at this space, we had to find alternate pools of capital to be able to, help these companies.
Yeah. Well, part of it is also what they're comfortable investing in is not necessarily early stage consumer brands. Maybe late stage consumer brands is a whole other matter, but early stage consumer brands is not necessarily what they're comfortable with or what their experience speaks to. It's interesting because, in the evolution of the technology venture capital industry, typically it's the VCs who are supposed to do early stage and the corporates do later stage, whereas what you're describing is you want to bring in the corporates in the early stages and bring in VCs maybe in the later stages.
So interestingly, if I can just, paraphrase that a little bit, it's not so much the corporates as in the family offices who are coming in at the early stage. Corporates are interested, but typically they would look at either acquisition kind of opportunities or more mature businesses with a path to acquisition. So that is a small nuance I wanted to highlight. And second,
good point. But I don't think family offices in the typical technology venture capital ecosystem even thinks about coming in the early stages of venture capital. So it is something what you're doing is basically tapping into people who have experience in consumer brands and have some comfort level. That's the real issue.
Absolutely.
So let's actually do a few case studies of your portfolio, the highlights of your portfolio, and we can do 3 or 4 of these. And what I would like you to do is take us through the evolution of these companies. When did they come to you? What did they have? What brought your confidence to those companies and what happened as they evolved? So let's understand the process of building these companies and growing these companies, including all the financial engineering around it.
Sure. So let me take an example of a company called Mama Earth. This is a company which basically targets the infant child or the baby and the mom as the key target market. And basically the company is about 2 years old, and the founder is it's actually a couple who started this company when they realized in their own experience when they had their first child that there was not a good choice of products that they could use on their child across various personal care requirements, whether it was obviously the usual shampoos and the oils and so on, but also some areas like diaper rash creams or safe mosquito protection products and so on and so forth. So they decided to start this company as a felt need for not only themselves, but millions of parents who are looking for what they call safer products for their child. So that was the kind of intuition. And I met Varun and Ghazal, who are the two founders, pretty much at the stage when they were conceptualizing this as an idea. Interestingly, right from day one, their focus was that this is not a discounted or a cheap play. They wanted to create products which were actually positioned at the, like I call the millennial parents. They wanted to give them products which were more superior, and they actually managed to get certification from a US-based organization called Made Safe, which actually has a 6-month process by which they actually certify your products as Made Safe, which means toxin-free, paraben-free, sulfate-free, etc. So that was the start of the engagement. They had conceptualized the brand. They had created a range of products through working with some R&D experts, and they were just about to launch it. So that was the time when I had invested first in this company. And over the last 2 years, they have been able to do a great job of establishing the brand among this community. Now coming to what has been the journey, some interesting learnings. One, they started this brand as an internet-first brand. So they launched it on Amazon Launchpad. They launched the brand on some specialized Indian baby marketplaces like First Cry and so on. And the focus was in building a community of moms who would endorse and recommend this product because they were users and they liked the product. So the interesting learning for us in this specific case was that if you can target some very core communities of consumers and they become almost like your surrogate spokespeople, the virality of that becomes a very interesting way to build the brand franchise. So the company has been, working with some of the largest mom and baby portals and sites in India, like Baby Chakra and the Mom Junction, the Mom Company, and so on. And that gives them that credibility of sales. Now, once they have established this, basic brand in the internet space, and now they are starting to take it to offline markets of the larger cities, etc. So I think that is a very typical roadmap that we are seeing companies follow with some, minor changes in terms of strategy, but build the brand
internet
through
first.
Online engagement. Yeah, so distribution on internet is one part of it, but even more importantly, using internet as a means to establish the brand credentials and the basic credibility around the brand.
Yeah. And what are the metrics of that? So what do you look for in terms of an internet first brand situation, in terms of how many customers, what kind of, what would be called success in building an internet first brand before you decide that, okay, now let's go offline and look for other channels?
I think the basic metric is always going to be how the consumer is accepting the brand and demonstrating their affinity to buy on a regular basis, because most of these businesses are high repeat businesses. And obviously, the metrics of repeat customer purchase, the metrics of the cost of customer acquisition, and obviously, if you're a regular customer, then that cost keeps coming down. So I don't think there is, while so we do look at the obvious metrics on internet brands, or like you said, the CAC and the long-term value and the revenue to advertising ratios, etc. But the most important metrics for us is the adoption of the brand as a regular brand for repeat purchase, and we use various methods to track that. And once we get that confidence that the consumer is now starting to accept this as a regular purchase, the brand in their basket of purchase, then it gives us the confidence to start looking at a more wider distribution play.
And how many do you think, in this case study, how many customers were they able to reach in an internet-only mode?
So
1 million, 5 million, what are we talking?
No, I think it's in more than 1,000.
1,000?
I mean, see, the important thing is that, like I said before, you can build very interesting businesses, especially in the Indian context, if you can reach a core community of consumers. Because we believe that this whole lifetime value of the consumer through buying on a repeat basis is far more important than just reaching a certain set of consumers. So 100,000 consumers who are buying our products on a regular basis is potential to be a 100+ crore brand, and in India, 100 crore brand, or let's say about $15 to $20 million of revenue, is seen as actually a very interesting milestone, since there are not too many brands in India that have got built to that size even today.
And how much capital do you need in this model that you're describing? What is your assessment of how much capital is needed to get to that 15 to 20 million revenue size with 100,000 customers, let's say?
So I think the broad number would be around 5 million. And again, this is a very, very wide hypothesis, but since we have been working with a lot of brands, this is roughly the number that I have seen for the last few years. So I think you can, so that is really a Series A kind of a stage of investing. So I think if we can raise about $5 million for the company, we can see the $15 to $20 million visibility of revenue through that fund.
And is that then getting to break even?
Yes. See, the good part about a lot of these brands is that they are very high margin businesses. So now if you take the case of Mamaearth, this is a 65-70% gross margin business, because personal care as a category typically operates at that level of margins. So the company can break even at a $10 million run rate. So the important point is, do you want to invest for further growth, which you have to invest in people, you have to invest in brand, marketing. So it's not burn management that you're raising further money for. It's actually for growth. So that is a very interesting distinction in our space versus, say, a typical tech company where you need to fund for burn for the first at least 3 to 5 years till you get the minimum size and scale.
Well, what I like also about the way you are thinking about these businesses is it has healthy unit economics built into the model, and that's sustainable. So, I mean, in the Indian context, I suppose, with a 15 to 20 million revenue company, you probably can even take it public, isn't it?
That may be a little too early. I would say in India, we have seen companies gone public between $50 to $100 million. So that's more like I would say the right metrics, because otherwise, these companies, even if they go public, there is high demand for consumer companies in the public markets, but then the float is so little that, exitability becomes an issue.
So what if you have to get up to 50 million? let's say 5 million to get to about 15 to 20 million in revenue, how much more money do you expect these companies will need to get to 50 million in revenue?
So, funnily, that is not a linear equation. So I would say that, again, my bet is 15 to $20 million should take you to that number of 50 to $75 million dollars of revenue. And then actually you can self-sustain and keep growing on that base. You don't necessarily have to raise too much more capital.
That's right. But that's what I was trying to get at, and I think my next question to complete this line of questioning is to understand to what degree of certainty do you foresee the family offices that are working with you to be able to cover that capital need of going from 5 million in capital to 15, 20 million in capital to finish that, sustainability process?
So, the interesting thing is that the private equity investors in India is a very large group, and they are very, very bullish on the consumer brand space. Mm-hmm. So interestingly, it's a very interesting funnel for consumer investing in India. The mouth of the funnel, if you may, is really the angels and the individual investors, which is pretty wide actually. So we see a lot of companies which can raise the initial, $100,000, $150,000, because people generally understand, it's a touch and feel. It's something that individual investors can figure out. Then mm-hmm. the funnel narrows because there are not enough VCs or early stage investors. And then it again widens out because at the 10 million plus mark, there is mm-hmm. a lot of private equity investors who will be interested to invest in companies. Because by that time, like I said, you have achieved $15, $20 million of revenue. You have a clear unit economic established. You have done some basic, groundwork on distribution networks. You have a team in place. The brand is in some sense established in whatever, capacity, either it's a geographic spread or it's an online first brand, but you have mm-hmm. enough confidence that the brand is for real, and now the private equity guys want to come in and invest further. So funnily, It's not even the need for only HNI money there. It is actually private equity players who are very comfortable writing 10 million plus.
So beyond 10 million, the private equity money gets unlocked. That's good.
Absolutely.
Now, besides Mama Earth, what other categories do you have businesses like this being built?
Sure. So, we have already done about 12 investments. Mm-hmm. And if I just cut it by broad sectors, 4 of them are in the food and beverage space, 2 of them in the personal care, 2 in lifestyle, 1 in home interior and home decor, 1 in education. So it's a fairly, wide mix of sectors, but everything being original brands catering to Indian market.
And through internet first. So now, can you answer one other question that strikes me as a relevant question in this context? Why do you have to go offline? If you're talking about 100,000 online consumers creating already a pretty robust business online, 100,000 is a very small number, with respect to the population that is online and that is very active online. You could easily get to, 2 million, 5 million consumers online. Why do you even need to go offline?
So I think 2 reasons. One is that there is a certain natural, I would say, saturation of the business if you are looking only online. And the cost of every incremental consumer keeps becoming higher and higher because you are spending, larger amount of dollars in acquiring the next set of consumers. So it's a classic case of the early adopter, and then, you have to work harder to get the next set of consumers. And second is that interesting learning for us, which is, I think, a very interesting insight, is that we have now seen several of our companies having done this internet first approach, building the brand through the internet. Mm-hmm. They start getting demand from the offline channels because there is a certain amount of rub-off effect which the offline channel also starts seeing. So I think it's in the long term, if you want to build a sustainable brand which can really, stand on its own feet, you do need to have a hybrid or an omni-channel strategy. It's really a matter of what is the timing of that entry into the offline channel and what strategy you need to adopt. So several of our companies have seen actually demand coming from the offline channels, and that is still in India or even worldwide, I would hazard, over 90% of the total market. So therefore, we can't ignore that large consuming class of consumers by completely staying online. I think online is a good way to get started, but certainly the efficient and more robust and sustainable model for building brands will be omni-channel, in my view.
Now, of your 12 companies, what is the geographical distribution?
Sure. So there is a large concentration between Bangalore and Delhi. So interestingly, we haven't seen that many new startups in Mumbai, but Delhi has been a fairly active thing. So although we are a single location based in Bangalore, so in some sense one would have imagined that Bangalore would be a large portfolio for us. But Delhi is the other one, which is almost as large as Bangalore.
And why do you think that is the case? I would have almost guessed Mumbai would be the concentration, but doesn't seem like it.
So, one of the things that we had noticed even in our experience when I was earlier with Helion and other funds is Mumbai, the cost of doing business is significantly higher than either Delhi or Bangalore. So unfortunately, that becomes a constraint because, of course, technology, Bangalore, because of availability of talent, tends to be the largest concentration. But Delhi, again, it's a large market. People, see that as a large opportunity. And if you are working in the NCR region of Delhi, which is, including areas like Gurgaon and Noida, etc., then you can, operate at a fairly low cost kind of budget. So that combination works in favor of Delhi.
Yeah. So I'm going to ask you a few questions that are more Indian market, more general questions, not specific to your fund. What is your analysis of the Indian e-commerce market?
Indian e-commerce market?
Yes.
Okay. So, see, again, the absolute positive aspect of that is that there is a very large consuming market, and e-commerce is satisfying several of those requirements which Indian consumers are not able to consume more branded products in terms of access, in terms of the reach, in terms of sheer logistics complexity. So for a typical large consumer brand, including the big players like Unilever and Procter and Nestle, to be able to reach the smallest remote corners of the country is both extremely expensive, and also the inventory first model where you have to place the product in these small towns and villages makes it very inefficient because you have to almost predict what will sell where and how does the inventory movement happen. So therefore e-commerce in India, I would say, is actually addressing an even larger need than some of the developed markets, which is just sheer access because of the complexity of the geography of what India is. I think the only challenge that we have seen and we continue to see is that because infrastructurally India is still evolving as an economy, the cost of doing business, especially in the e-commerce context, is very high because you have distribution costs, logistics costs, the payment systems. All of these are still in a very early evolutionary stage. So therefore, that's why you see the kind of investments that are required and the fact that only a few, large players are able to sustain that kind of financial needs to build the ecosystem. But there is no doubt, I think, in my mind or anyone's mind, that e-commerce is going to be a very important player in the overall evolution of consumption or brand consumption in India.
And this doesn't really impact you and your style of companies because you are operating with a small affluent segment of the urban consumer, more or less. So you don't really have to worry too much about the logistical complexity.
Absolutely. So our focus as far as consumers is, like you said, more metro, more urban, but we obviously work with all the e-commerce players very closely. So
right.
We do get access to some of these smaller markets as well through that.
But it's not an essential piece of your strategy. So and the logistics are in any case being handled by the e-commerce players. So you don't really have to worry about logistics. Interesting. Okay, I think I have more or less your perspective. Is there anything I should have asked you that I missed?
No, not something you missed, but I just want to point out something which we are very excited about as a data is that over 50% of our portfolio companies actually have women co-founders.
Very good.
So I'm highlighting that because, that is one of the areas that we believe very strongly that, especially in the consumer space, my personal hypothesis is that almost 80 to 90% of all household consumption across the family is influenced by a woman in the house.
Yes. Mm-hmm.
So it is so natural that, women co-founders become a very important and integral part of the ecosystem that we are part of. And we are very pleased to say that we actually see that manifesting itself even in the early days of our fund.
Very good. Excellent. Well, thank you, Kanwal. That was an excellent conversation, and it's very encouraging to see that you're filling a real gap in the ecosystem, and it's very promising. I think I really am a big believer in this opportunity for India. I don't know if you read my Vision India 2020 book. I wrote it back in 2009 and it got published in 2010. And I had whole sections on consumer brand opportunities in that book, but very little has actually happened since in this period. And part of the problem is that the financing ecosystem has not really been there to build consumer brands to that scale.
So let's hope that we can trigger more interest in this space. Thank you so much. It's been a pleasure.
Very good. Consumers will enjoy new brands, and entrepreneurs, our audience, will very much enjoy building them. So thank you, audience, for listening. And as you know, on the website 1Mby1M.com, you can go and register for a free public roundtable. We'll be happy to work with your business and give you whatever guidance you are looking for. So go register, go show up at one of the roundtables, and we'll look forward to working with you. And we'll be back with another edition of the 1M by 1M podcast.